Markets are never certain, and that's exactly your advantage.
Time and uncertainty shape every investor's journey.
The question is, do you see risk?
So what's the single biggest difference between an amateur investor and a professional? It's not some secret software or a genius-level IQ. It's something much deeper, much more fundamental. It's all about how they think about the future.
You see, the amateur is almost always on this frantic hunt for certainty. They're looking for that sure thing, right? That one guaranteed winner, the stock that's just destined to go to the moon. They treat the market like it's a puzzle with only one right answer.
And this right here is the whole ballgame. The amateur asks a simple black or white question. Will this stock go up? Yes or no? But the professional? They ask a much, much smarter question. What are the odds of all the possible outcomes? They're not trying to predict one single future. They're trying to map out a whole range of potential futures and figure out how likely each one is.
So here's the key takeaway. Leveling up your game isn't about finding a better crystal ball. It's about completely shattering the illusion that a crystal ball even exists in the first place. The goal isn't to find certainty, it's to get really, really good at navigating uncertainty.
Then that brings us to the professional's core mental tool. Instead of chasing the ghost of certainty, they use a framework that's way more powerful and, frankly, more in tune with reality, thinking in probabilities.
So what does that actually mean? Well, think about a weather forecaster. They don't look you in the eye and say, "It will absolutely rain tomorrow." That's a false guarantee. Instead, they say something like, "There's a 70% chance of rain." They are describing reality as it is, uncertain. And that's the exact same mindset that pros bring to the market.
Okay, so how do they put this into practice? Is it just a feeling? No way. One of the key tools is a little calculation called expected value. Now, it looks simple, but its real power is that it forces you to think about both the probability and the size of your gains and your losses. It shifts your brain from just a simple up or down guess to a much richer, more realistic way of looking at any investment.
Now, if this all sounds pretty straightforward, it's not. This way of thinking is actually incredibly difficult, because our brains are hardwired to fight against it. We're certainty-seeking machines by nature, and that wiring leads us right into some nasty psychological traps. We're going to dive into 3 of the most common traps that stop us from thinking clearly in probabilities: overconfidence bias, hindsight bias, and the narrative fallacy.
First up is overconfidence. You know the feeling, right? You spend hours, maybe days, researching a company, and all that effort creates this illusion of control. You start to feel like you've somehow eliminated the risk and the randomness, when all you've really done is become more familiar with the story.
Then there's hindsight bias. This is the classic "I knew it all along" effect. When we look back at something huge like the 2008 financial crisis or the dot-com bubble, it all seems so painfully obvious now, doesn't it? Well, that feeling tricks our brain into thinking that the next big crash or the next big boom will be just as easy to spot ahead of time, and that is a dangerous, dangerous illusion.
And finally, we've got the narrative fallacy. Our brains are absolute suckers for a good story. A simple, clean narrative like, hey, electric vehicles are the future, so this stock has to go up, is so much more satisfying than a messy, realistic assessment like, well, there's a 60% chance of a 20% gain, but there's also a 40% chance of a 15% loss. The story just feels more certain, even though the probabilities are what really matter.
Okay, so we've identified the mental traps that we all fall into. Now, let's flip the script and look at the solution. How do the pros actually overcome these biases and apply probabilistic thinking day in and day out?
It really comes down to a 3-part playbook. They actively look for asymmetric bets. They build a portfolio of probabilities, and maybe most importantly, they are relentless about focusing on their process, not on any single outcome.
First up, asymmetric bets. A pro isn't looking for a 50-50 coin flip. They're hunting for opportunities where the potential upside is just massively larger than the potential downside. The classic example is a venture capitalist. They know that maybe 9 out of their 10 investments will go to zero, but that one single winner that returns 100x, it pays for all the losers, and then some. That's asymmetry.
Second, this mindset totally changes how you build a portfolio. An investor trapped by the certainty illusion might go all in on their one best idea. But a probabilistic thinker knows that even their absolute best idea has a real chance of failing. So what do? They diversify. They build a portfolio. They're managing a collection of probabilities, not a collection of supposed sure thing.
And this
This might be the most crucial part of the whole thing. Pros focus on their process. In a world with luck and randomness, a really good, well-thought-out bet can still lose money, and a terrible, impulsive bet can sometimes win. They don't beat themselves up over a good bet that goes south. They judge the quality of their decision-making process, because they know that a good process will always win out over the long run.
So here's the best part about all this. This mindset, it's a skill. It's not something you're born with. It's a muscle that you can train. So how can you actually start building it?
Let's talk about hitting the mental gym. Here are 3 simple but incredibly powerful exercises you can use to start building your probabilistic thinking skills literally today. First, write it down. Seriously, before you make an investment, force yourself to actually assign percentage probabilities to the different outcomes. What's the chance it goes up 50%? What's the chance it goes down 30%? Just the act of putting a number to it completely shatters that all or nothing thinking.
Second, do what's called a pre-mortem. This is an amazing technique. You imagine it's a year from now, and your investment has been a total disaster. It's failed. Now write down the story of exactly how and why it went wrong. This exercise forces you to see all the downside risks that your natural optimism might be trying to ignore.
And third, keep a decision journal. Write down why you made a decision, what your probability estimates were, and then you have to track the results. Over time, you can go back and see how accurate you really were. This creates an invaluable feedback loop. It's essential for getting better and for keeping that natural overconfidence in check.
When you really boil it all down, it comes to this. In a world where almost everyone is desperately searching for some magic formula for certainty, just learning to accept and navigate uncertainty, that is a genuine superpower.
And that is the ultimate mindset shift. You have to let go of the pressure to be right 100% of the time. That's not the goal. The real goal is to be profitable over the long term by consistently and methodically putting the odds in your favor over and over again.
So, I'll leave you with a question to think about. When you reflect on your own decisions, which of these mental traps, the overconfidence, the hindsight bias, or that tempting narrative fallacy, which one is the hardest for you to avoid? Because just being honest about that, that's the first step to building your superpower.